Hello everyone, welcome back. We will be covering the last chapter of this course, which is chapter 13, and this is on financial statements and closing procedures. In chapter 12, we discussed the accrual accounting and completion of a worksheet for a merchandising business. And now in chapter 13, it will explain how to use the worksheets to prepare and record adjusting and closing entries, how to prepare a post-closing trial balance, and how to prepare financial statements. And so many of the concepts that you will see in this chapter have already been previously presented to you. However, they've been presented to you at a surface level. So this chapter basically wraps up what we have been learning in a little bit more detail than how it was presented to you before. So one of the objectives is actually to prepare an income statement from the worksheet. So we will be covering that in a little more detail than before. So we have learned that in the accounting cycle, we have a section or part of the cycle is to prepare financial statements. And at the end of the period, one of the financial statements that must be prepared is the income statement. So what we're going to learn today is about the classified income statement, which is sometimes called the multiple step income statement. Now, this type of income statement contains several subtotals, which are computed before the net income is calculated, and it's a little bit longer than the normal income statement that you have learned in the past. The end result is still the same though. Our goal is to actually determine if the business has a net income or a net loss. So in other words, what you need to determine is if the business makes money or made money or lost money for that particular period. Now, the classification and order of information depends on the type of business and the expected use of that statement. So you're probably wondering, so what is the difference between the normal income statement and the multiple step income statement? Well, the income statement that we have learned in the past is called the single step income statement. And the single step income statement is a format in which by only one computation is needed to determine the net income or the net loss. So to determine the net income, you would usually take the total revenue for the period and then you would subtract all of the expenses for that business in that same period to determine the net income. In cases where the expenses exceeded the total revenue, we would report a net loss rather than income. So here's a visual of the first section of the multiple step income statement. We will begin with operating revenue. And here we show that the revenues earned from normal business activities are the sales, which in this case are reported at $561,650. We also need to consider any sales returns and allowances and make sure that we subtract those returns and allowances from the sales. If we don't do that, we will be reporting higher sales than what had actually occurred in the business period. So in this case, the sales returns and allowances total $12,500. So when we subtract this number from the sales, we report the net sales for this business, which is called Whiteside Antiques, as $549,150. So the next section of the multiple step income statement is the cost of goods sold. We actually could abbreviate that using an acronym with COGS or COGS. And this is usually the most challenging section for you to compute. The cost of goods sold section contains information about the cost of the merchandise that was sold during the period. And in this case, the three elements that are needed to compute the cost of goods sold is the beginning inventory, the net delivered cost of purchases, and the ending inventory. And what we will be covering in the next few slides is how to come up with those three calculations. Each of those calculations is part of the multiple step income statement, but to get there, it will require you to consider other accounting accounts in order to make those proper calculations. So, to determine the cost of goods sold, you begin by determining the beginning merchandise inventory. And this is the inventory level at the beginning of the business period that you are reporting. So, you also need to determine and add the net delivered cost of purchases, which is determined by adding the cost of any purchases that you made during that same period, and also add the freight in. Once you do that, then we must subtract any purchase returns and allowances, and also subtract any of the purchase discounts. Now, when you make these calculations, this is not going to get you to cost of goods sold. This is only determining the net delivered cost of purchases. To determine the cost of goods sold, you will subtract the ending inventory at the end of the period. So remember that the cost of goods sold section contains information about the cost of merchandise that was sold during the period. So let's look at this visually. Here's the visual of the cost of goods sold section. This is only labeled as partial income statement. This is the second section that I'm showing you for the multiple step income statement. And we label that as partial because I'm only showing you the section that determines the cost of goods sold. Okay, so here we see that the beginning inventory levels on January 1st is $52,000. So what we need to do is we then need to determine the net delivered cost of purchases, which is determined by adding any purchases. In this case is $321,500, and then also add in a separate category for the freight costs, which in this case are $9,800. So this will determine the delivered cost of purchases, which is adding those two values to obtain $331,300. Now, the previous slide also states that we must subtract the purchase returns and allowances and the purchase discounts. So these are $3,050 and $3,130 respectively. You'll see this in the visual. And these two values add up to $6,180. So therefore, in order to determine the net delivered cost of purchases, we will obtain $325,120. We then have to determine the total merchandise available for sale, which is determined by adding the beginning inventory to the net delivered cost of purchases. And this will be $52,000 plus $377,120. So now the only thing that we need to do is one more step, which is to subtract the ending inventory, which in this case is $47,000. And this type of information is given to you in the problems. And this will give you, finally, what we are trying to convey here is we're trying to determine the cost of goods sold. And after we do all these steps, we determine that that is going to be $330,120. So like I said, this is going a little deeper than what you have learned before, which was more of the surface level and it had less categories. So that's why it's called the single step, and this one that I'm showing to you is the multiple step. So I know that this is a lot of information to absorb in one slide. So here's a separate slide to help you understand how to determine the net delivered cost of purchases. These are all the steps that we need to take in order to determine the cost of goods sold. So make sure that, if you need to understand that a little deeper, just really understand these slides. Likewise, here's a slide on that breaks down how to determine the total merchandise available for sale. And then for merchandise inventory, This is one of the accounts that appears on both the income statement as well as the balance sheet. Now, the ending inventory appears on the balance sheet, and both beginning and ending merchandise inventory balances are needed in order to figure out the cost of goods sold. So remember that merchandise inventory is an asset account, and the rules for debits and credits are the same as any asset account, which means that in order to increase the account, we need to debit the account, and if we want to decrease the account, we need to credit the account. So our goal is to determine the net profit or net loss of a business for a specific period. For example, we have been using in this chapter the Whiteside antiques. So for this particular business, the net sales is the revenue earned from selling the antique items. And then the cost of goods sold is what Whiteside Antiques paid for the antiques that were sold during the fiscal period. So the gross profit is what is left over in order to cover operating expenses and to provide a profit. So let's build on this multi-step income statement based on what was just discussed. Here we see, and it's still a partial income statement because we're not done, but here we see that we need to determine the operating revenue, which is the third section, in order to achieve our goal of finding out if we have a gross profit or a net loss. So we do this by taking the sales for the period and subtract the sales return and allowances, and this will give you the net sales, which in this case is $549,150. We then determine the cost of goods sold. And recapping, we do this by taking the beginning merchandise inventory for the period, and then we add the purchases and the freight in, which will give you the delivered cost for purchases for $331,300. And then we subtract both the purchases, returns, and allowances and the purchase discounts. So we have a total merchandise available for sale for $377,120. And lastly, we subtract the ending merchandise inventory for the period, which will give us a cost of goods sold. So therefore, our gross profit on sales will be determined by taking the net sales of $549,150 and then subtracting the cost of goods sold, which in this case is $330,120. So our gross profit on sales is $219,030. Now again, I know this is a lot of information, but if you just take your time in reviewing what I'm just saying, it should all make sense to you. So now that we have our gross profit, we now need to determine the operating expenses. And the operating expenses are separated into two categories. One of them is the selling expenses, and the second one is the general administrative expenses. The selling expenses include salesperson salaries and advertising expenses. Basically, in this category, you determine any expenses that are connected to selling products for your business. And those may include like advertisement, employees that are selling products, so they must be on the floor, supplies and any store equipment like the POS systems in order to help you sell the products or a service. The difference between the selling and the general and administrative expenses is that we don't include any selling expenses as general and administrative expenses. These general and administrative expenses are like rent expense, salaries for employees working in the office setting, not necessarily selling directly the product, insurance expenses, telephone expenses, or equipment that are used by the office employees, like the computers that are not actually being used in order to sell a product. So once you categorize your expenses based on these two categories, you will need to add them up to determine the total operating expenses. So for this example, for this slide, you'll see that there are two categories. You'll see how they're both being differentiated over operating expenses versus the general and administrative expenses. And so our total operating expenses for this example is $167,833.80. So finally here, after subtracting the total operating expenses from our gross profit figure, the business can now finally determine its net income or its net loss for operations. So in this case, for Whiteside Antiques, it's reporting $51,186.20 of net income from operations. Now, note that the cost of goods sold section has been collapsed to a single total, and this is only for space considerations, and it'll be next to impossible to see if I added every single line in order to present the partial income statement. So remember that for your homework, you will need to include the sections we just discussed. Excuse me. Now, keeping operating and non-operating income separate helps financial statement users learn about the operating efficiency of the firm. So our last section on the multiple step income statement is categories such as other income or other expenses in the section if it applies. Okay, so income that is earned from sources unrelated to the normal business activity is classified as other income, and that would appear in the other income section. So expenses which are incurred but not directly connected with business operations usually appear in the other expense sections, and usually that would include like interest expense. So the total other income for this particular example was $532, and other expenses totaled $770. So the difference was the net non-operating expense of $238. Oh my goodness. So finally, we're here. After subtracting the net non-operating expenses from our net income from operations figure, the business can determine its net income or its net loss for the period. Yes, we're finally here. So in this case, Whiteside Antiques is reporting $50,958.20 of the net income for the year. So this is putting everything into perspective, and you'll see how small it is, but you could most likely see this in your textbook as an example of how this works. So that was for the income statement. After we complete the income statement, we prepare what we know as the statement of owner's equity. And the statement of owner's equity reports the changes that occurred in the owner's financial interest during that period. At the end of the period, Bill Whiteside, or Capital, had a balance of $84,579.20. And the statement of owner's equity analyzes the owner's capital account for the period, and the ending capital balance is used to prepare the balance sheet. So the next financial statement is the classified balance sheet. And again, we use the worksheet to help us prepare the financial statement. And a classified balance sheet is very similar to the balance sheets we have already prepared in the past, except that the assets and liabilities are classified into separate categories. And so the first section on the classified balance sheets is the current asset section. So current assets consist of cash. It consists of items that will normally be converted into cash within 1 year, and items that will be used within 1 year. And those are usually like cash, accounts receivable, merchandise inventory, supplies, etc. The current assets are usually listed in order of liquidity, and current assets are vital to the survival of a business because they provide the funds needed to pay bills and meet the expenses and the demands of the business. So liquidity in this case It's items that can be converted into cash quickly. And cash is a highly liquid asset, so it is listed first in the current asset section. And then the total current assets for Whiteside in this case is $98,716. Plant and equipment is our next asset classification appearing on the classified balance sheet. Plant and equipment is property that will be used in the business for longer than 1 year, and that would include buildings, equipment, and land. Now, non-current assets are called long-term assets because they have a life greater than 1 year. So for many business plants, for many businesses, plants and equipment represents a sizable investment. So any accumulated depreciation accounts are shown below the respective accounts. So the total plant and equipment for Whiteside Antiques in this case is $130,616 for total assets. Now the liabilities section comes next on the classified balance sheet. Liabilities are classified into two sections, current and long term. And remember that current liabilities are debts that must be paid within 1 year, and current liabilities are usually listed in order of priority of payment. So the total current liabilities for Whiteside Antiques in this case is $46,036 with 80 cents. Now, after current liabilities comes long-term liabilities. And remember, the long-term liabilities are debts of a business that are due for more than 1 year in the future. So long-term liabilities will include such things as mortgages, notes payable, and loans payable. And for this particular example, there was no long-term liabilities for Whiteside Antiques as of December 31st, 2019. So we won't have that for this particular presentation. The last section on a classified balance sheet is the owner's equity, and we will use the owner's capital ending balance off of the statement of owner's equity prepared earlier. And if you need a refresher on how these financial statements connect, please go back to previous chapters where it was covered. And then after transferring the capital account balance from the statement of owner's equity, we can complete the balance sheet. And the total liabilities and owner's equity here is $130,616. And note that this total must equal the total assets. So after all the financial statements have been prepared, the adjustments are made a permanent part of the accounting records, and they are recorded in the general journal as adjusting journal entries and are posted to the general ledger. And we covered adjusting entries as well before. So here's a recap of the adjusting entries that were previously discussed. Each one of them would need to be journalized and then posted. Remember to write the word adjusting before you journalize them, and also write the word adjusting in the description column of the general ledger. So in this case, for inventory, we adjust to remove the beginning inventory and then adds the ending inventory to the accounting records. For expenses, the purpose is to match the expenses to revenues for the period. Remember that the credit in this case is a contra asset account. For accrued expenses, the purpose is to match the expenses to revenue for the period, and the credit in this case is the liability account. And then lastly, we have prepaid expenses, where the purpose is to match the expenses to revenue for the period. So remember that the credit is to an asset account. Now we are ready to close the temporary accounts. Notice that this is nothing new again. We previously covered this in the course, so if you need a refresher, you could go back to the previous chapters. But the temporary accounts are revenue accounts, cost of goods sold, all expense accounts, and the drawing account. Now, during the closing process, changes in the temporary owner's equity accounts are transferred to the permanent owner's capital account. And we will use the same 4 steps in the merchandise's closing process that we discussed before. So we will close revenue accounts and the cost of goods sold accounts with credit balances to income summary. And then next we will close the expense accounts, cost of goods sold accounts with debit balances, and any contra revenue accounts with debit balances to income summary. And then next we will close the income summary, which will now reflect the net income or loss for the period to owner's capital. And finally, last step will be to close the drawing account to owner's capital. So here are examples of the closing process to refresh your memory. For step 1, we close the revenue accounts and the cost of goods sold accounts that have the credit balances. And we do that by debiting accounts such as sales, interest income, miscellaneous income, purchase and returns and allowances, and purchase discounts. So notice that we have to debit each account separately, and we make credit to the income summary account. For step 2, we close expense accounts, the cost of goods sold accounts with debit balances, and any contra revenue accounts with debit balances to income summary. So you're probably wondering, how do we do that? What we can do is look at the general journal worksheet, and when looking at the worksheet, we close the expense accounts and the cost of goods sold accounts with debit balances, as well as any contra revenue accounts with debit balances to income summary. And we make a corresponding debit to the income summary account. Step 3, we will close the income summary account, and we do that by closing the balance into the owner's capital account. And those steps are discussed in previous chapters. So we do this third step by debiting the income summary and by crediting the owner's capital, which in this case is for Bill Whiteside. Lastly, for step 4, we close the drawing account and we close the balance into the owner's capital account. So we debit income summary and then we credit the owner's capital. So just another refresher, why do we close entries? Remember that we need this process to bring the temporary account balances to 0. So remember also to write the word closing in the description column. So now what we need to do is prepare a post-closing trial balance to confirm the general ledger is in balance. So the only accounts that have balances are the asset, liability, and owner's capital accounts, and those appear on the post-closing trial balance. So remember that the totals for the post-closing trial balance and the balance sheet will be different, since the balance sheet, since on the balance sheet certain credit account balances are subtracted from certain debit account balances. So on the post-closing trial balance, all debit and credit balances are shown on either on the left side for debit or on the right side for credit of that report. Also remember that only the accounts that have balances are the assets, liabilities, and owner's capital accounts, and they appear on the post-closing trial balance. So the temporary accounts, including revenue, cost of goods sold, expenses, and withdrawals, do not appear on the post-closing trial balance. So the post-closing trial balance is presented in here in this slide. Notice that the only account types that are not closed out are the assets, liabilities, and the owner's capital account. Again, nothing new here. Another thing that we previously learned was reversing entries. And the last step in the accounting cycle, which is actually an optional step, is to prepare reversing journal entries. And reversing entries are journal entries made at the beginning of an accounting period that are the opposite of certain adjusting entries, particularly those for accrued expenses and accrued income. Reversing the entries are made to reverse the effect of certain adjustments. So this helps to prevent errors in recording certain cash payments or cash receipts in the new accounting period. Now, this is the last chapter of the semester covered in this course. Here is just the review of the accounting cycle that was covered in the course. We have 9 steps listed here since reversing the entries is an optional step. So we do not include that as a formal step in the cycle. And that is all. This will be the last chapter for this course. So it's pretty much a summary and putting things together into one perspective in terms of the accounting cycle. Thank you for taking the time to be here. If you have any questions, please reach out to me. Thank you for your time.